Hello traders, what's going on? So for this session, right, we are just gonna give you a short update on what is going on. And of course, we definitely need an update. We have a face rate rally that is ongoing at the moment. So far, the future seems to have kind of loses its steam, but let's see what we have. Okay. So brief time check. We are on 5th of October, Wednesday at close to 1 p.m. in the noon. I'm about to have my lunch, but I thought I should bring this out first, lah. Okay. So firstly, this face rate rally is I would say very aggressive, very aggressive. Within a span of 2 days, the market actually S&P went up from the bottom to the top 235 points in just 2 days alone. So if I go to the monthly chart, you can see that we ended September on a very bad note. Of course, for the best, this is definitely good, but jumping right into quarter 4, the first week of October, we have this S&P fought back with a vengeance, lah. Okay, so we have to see what is contributing to all these market rally, and it is important because we need to identify if this rally has any backing, any I would say, how should I put it, any form of substance or not, or is it just another irrational rally that we can actually short at the high again, lah. Okay, so throughout the entire of 2022, we have often faced with many irrational rally that provide us a big opportunity to short higher. Even at this stage, right, I am still overall bearish on a mid-term perspective, right? I'm still bearish, but we do need to ensure that we don't get caught in this kind of face rate bear rally, lah. Okay, so looking back at a few public analysis that I have made and shared, right? We were kind of expecting this rally as early as September 29. Okay, on the September 29th, when S&P broke through the resistance at 3720, right? I was kind of expecting this rally, and in fact, I for most of Nimbus Capital community, right, we actually liquidated most of our short position. In fact, we were holding about 4 or 5 short position on counters like Marriott. Let me just show you some of those counter. Okay, we were holding short positions on counters like Louisiana, where we had a short from here. Also Marriott, also General Motor, and also Ford for those with option. So actually we liquidated all this short position like around 26, 27 September, like that, mainly because we think that, okay, I think market have gone down enough. we should cash out first before things start to get ugly, lah, where the bear rally come into play, lah. But nonetheless, we are still holding some of our shorts. So those 1 or 2 short counters that we are holding, unfortunately they are in the red, but we were able to cash out majority of our short position during this period, lah. Okay. So let's go back to S&P 500. So we were expecting this rally here, where when S&P broke through 3720, we expected it to go to 3800, like that. So we were preparing for hedging position and things like that, and only to see that on the 30th of September, market went all the way down. Market went all the way down and broke 3,600, and only for it to recover back by almost 200 points this week, and actually hitting 3,800 level. I believe for a short period, it missed by a bit, but I will consider it hitting that resistance level, lah. Okay, so because of that, right, I posted another analysis again in case people miss out. So yes, the bear rally is still on the card, so you can look at this. This is on our, I mean, you can follow us on TradingView or Investing Note or our Telegram. You can see it in the YouTube description, lah. Okay. So let's just go through the reason for all this stuff that is happening. Firstly, there isn't any news related things that is incoming, but we do have the 10-year bond yield that suddenly crashed during the past few days. Okay, it started crashing on 28 September. So on 28 September, right, it was our first clue. It was our first clue that, okay, maybe we might need to be a little bit careful with our short position, because when the 10-year yield goes down, the stock market actually goes up. Currently, the bond yield and the stock market is in this inverse relationship. Okay, so if you want a good example of the yield versus stock market, right, you can see that when the 10-year yield crashes in 15 June and 16 June, this period here, what you notice is that actually marks the temporary bottom for the stock market. You can see 15, 16 June, okay? This marked the temporary bottom for the stock market. So when we saw this 10-year yield crashing, right? This was the main driver for us to get out of our most of our short position. We can still hold one or two, but at least we cash out those that are in profits. Okay. So and then a few days later on 3rd of October, which was Monday, right? We see another big dive in the yield. And that is where you saw that truly face rate rally incoming on the the S&P 500, where the futures actually went down in the morning, but when the market opened, right, it recovered about more than 100 points. Okay, so the yield is mainly the driver that is coming in to cause this rally. But on top of the yield itself, right, we also have US dollar diving together with the yield. So US dollar correlation with stock market in the current economic condition, right, is US dollar down, stock market goes up, because a very strong dollar is bad for corporate earnings, especially when you have a lot of earnings coming from overseas, like Apple, Microsoft, Tesla. Excuse me. Sorry, I thought I was about to sneeze. Okay, so these are the two drivers for the face rate rally that we are seeing for the past 2 days. Okay, so for the US dollar going down, right, there are catalysts coming in that cause the US dollar to go down. Mainly, we have the Bank of England intervention, which causes a stronger pound, and we also have Bank of Japan intervention quite a while back. And the Chinese are also liquidating their US Treasury. So all these exogenous shocks are coming in to sort of attack the US dollar. These are something that we couldn't predict, because they are like a sudden catalyst. Okay, so that is probably why the US dollar is going down. But the yield itself, right? There isn't any news related that causing the yield to go down. I believe it is just that the bonds are very oversold, and then now they are just doing a short term. The bonds are doing a short term rally, which is why the yields are going down. Okay, but there are a few news related stuff recently, and one of them is, let me go and find. One of them is actually the RBA. Sorry, let me just control find. Okay, it's not it's not here. Sorry, give me a minute. Let me go and bring out the article. Okay. I swear I had it open. Okay, so we actually have RBA hiking less than expected. Okay, the Australian bank. So I believe they were supposed to hike by 50 BPS, but they actually hiked by 25 BPS. So this isn't really a pivot, because they are still hiking, but they actually hike less than expected. So it does kind of bring in this bullish euphoria, bullish sentiments, like hey, what if Federal Reserve is gonna do the same thing? Like, okay, maybe they may not pivot, but they may slow down the pace of hiking, because when we go through the summary of economic projection previously, right, we noticed that they are going to hike as high as 4.4%. 4.4%, sorry, I think it was 4.5% federal rate hike, and maybe they might start to slow down also. So I think this is also a contribution factor towards the market rally. And on top of that, which there are also another two more stuff that came in, two more data that came in. I don't believe these two data are major contribution factor, but nonetheless, I believe they do provide a little bit of encouragement for the market rally. One of them is the ISM manufacturing PMI. It actually went down. It went down to 50.9. So what this ISM manufacturing PMI tell you is that the growth of the manufacturing sector, okay? How well is the manufacturing sector doing? So if you look at the entire GDP of US, right? You have your manufacturing sector and you have your service sector. So these are the two major contribution to GDP, and they contribute to earnings and they contribute to the global economic growth, all this kind of stuff, right? So it is sort of highly related to it affects things like interest rate decision and all this. So normally when you see ISM going down, it went lower than previous month, but it was also lower than the forecast. So normally in a normal situation, when you see this, right, this is actually quite bad because the growth in the manufacturing sector is slowing down. It is quite a bad thing to be in, and you will see stock market go down. But our situation right now is very different, very unique, because currently we are in the bad news equal good news environment, where anything that is bad news related to economic growth, right, is considered good news because it means Federal Reserve is gonna pivot. So anything bad news like unemployment went high, the growth is slowing down, people are buying less home, all these things are considered very good news because it will make Federal Reserve pivot much sooner. Okay. So we have one bad news equal good news, and we also have another one bad news equal good news on the jobs opening. Jobs is the is like counting the number of jobs available. Okay, and when we look at the jobs opening, right, you can see that it has been declining. The number of jobs opening has been declining and declining. So it does seems that there are lesser and lesser jobs opening, which might lead to unemployment in the future. So once again, right, under any normal condition, this is not really a good news, but based on the situation we are here right now, bad news is good news because it will ensure that Federal Reserve will pivot much sooner. So basically, this is the situation that we are having we are having right now. Okay, so these are the few contribution factor that is causing your stock market to rally in the past few days. So how long can this rally last? We don't really know, but we can kind of use technical analysis to predict a few level, to sort of have a few gauge level. Definitely 3,800 is the first level that we want to be aware of. So it has definitely reached that level already, but we can use previous event as our so-called guideline now. Okay, so this is the Jackson Hole candle, this is the CPI candle, and this is the FOMC candle. Okay, so now the FOMC candle is like deciding the next two level. So the low of the FOMC candle is 3008, sorry, my bad, and the high of the FOMC candle is about 3009. So these two are your so-called the next resistance level. But if the market were to break above the FOMC candle, right, then it is like signaling that whatever nonsense that Jerome Powell say, Federal Reserve say during that FOMC meeting is no longer valid, because now market has overtaken that level already. Okay, so that we can kind of, if market rally beyond that, right, we can use that as like a justification to go for a long position. But you cannot be always one-sided. We must always look at it from the other side of the coin also. Firstly, right, if you look at this rally, it is very reminiscent of the rally we've seen here, where market suddenly rally into the CPI reading. The CPI reading haven't come out yet, but the market is like kind of getting ahead of itself. It just went all the way up, and then when the CPI comes out, it just undo all the rally that you have done. So the CPI reading is coming out in next week, I believe. So you have to be a little bit careful about going overboard with this rally. Okay, who knows, it's gonna green, and then everyone pre-celebrating, and then when the moment CPI come out, everything just crash all the way down. So okay, so we have seen from past PCE report that the CPI is still quite that there is inflation embedded within the economy already that is not related with energy prices or food prices. It is actually within USA itself there is inflation that's embedded that is not very hard to get rid of. We saw that in the PCE data. So and that is happening after 3 rounds of 75 basis point hike. So it's a little bit too early to celebrate that inflation is over lah. Okay, so these are the stuff that going on. So currently for us, right, within our community, Nimbus Capital, be it our course or Patreon, I will not say that we escape this rally unharmed. Definitely we are bearish, but we managed to sort of minimize the damage done to our portfolio, mainly by exiting majority of our short position. We are still holding 1 or 2 short position, but in fact, we actually, one of our short position we have was Tesla. We actually had Tesla shorts, and Tesla is one of the counter that is severely underperforming this week. Okay, so Tesla short, some of us got Tesla short as early as 300. The latecomer actually entered on Monday lah. During the gap down lah. Okay, enter on Monday during the gap down. So those who enter on Monday during the gap down, we are not really in danger. We are at most break even, but those entered in 300 is quite a big profit. So if you look at the weekly performance, right? If you look at weekly performance, let's look at S&P weekly performance. S&P recovered from last week bottom, the last candle bottom. S&P actually recovered 5%. Okay, but let's look at Tesla. Let's look at Tesla. From last week bottom, Tesla actually went down 6%. So it is severely underperforming with regards to the market itself. Okay, so from here, right, we can say that Tesla is very, I would say, not doing well right now. Okay, so a few things that is happening with Tesla. Number one, they missed their product vehicle delivery number. Yes, the delivery number was among the highest, record breaking, whatever, but it doesn't matter because the market expect higher. The market expected higher, and then Tesla wasn't able to deliver that lah. The reason why price are so high, the reason why Tesla price is so high, whereas Apple is like crashing, or whereas a lot of other counters are crashing, but Tesla is still able to remain at this level, right? It's because market expect a good delivery number, a very high delivery number. But when Tesla wasn't able to meet that delivery number, right, the price crashes lah. Okay, and then yesterday, on top of that, we also have the whole Twitter situation. So I think Elon Musk definitely have to buy Twitter at $54.2 per share. So the article make it sounds like it is Elon Musk's decision to buy Twitter at 54.2, but I don't think it is his decision. I think there are a lot of legal situation that left him no choice. It's either he have to pay a very big fine for going back on his initial deal, right? And I think he didn't want to pay the fine, so he ended up going through with his original deal. But I really don't like it that the articles make it sound like it is Elon Musk who is in control. I believe he has zero control over what's going on, because everything is now it's a legal issue already. Okay, so because of that, right, what you see was Initially in yesterday, this is Tesla. Yesterday, earlier in the market, we have Tesla rally, very nice. And sometime around midnight, it just crashed all the way due to the whole Twitter news coming out. Okay, but towards the end of the US session, Tesla did recover a bit, but it is far from the high. Okay, it is far from the high, and it is quite close to Monday's bottom also, somewhere in the middle to Monday's bottom. But nonetheless, right, if you look at S&P going up 100 points on Monday, going up another 100 points on Monday, and then you see Tesla having this kind of price action, right? This is definitely not good for Tesla. Okay, so imagine if in the next few days, market decide to come back down, most likely Tesla gonna go down as well. So this is what we are having right now. So going forward, right? Going forward, what is our plan? What are we trying to do? So I'm not sure what you guys are going to do, but for our community, our Nimbus Capital folks, right? We do have a few long position in case market continue to rally, but we also have a lot of short position that are in the watch list that we want to take at higher prices. This current rally give us that opportunity when the market start to U-turn, right? We are going to take some of the shorts on our watch list at a higher prices. At the same time, we are still going to hold on to some of our longs, because if they are doing well, right, then what for are we going to let them go? The difference between us and most other community out there is that we employ a long short equity strategy. We are not 100% long, we are not 100% short. We don't just trade index, we don't just trade triple Q, SPY, index CFD. We don't trade those. We trade stocks, we trade individual stocks. We will buy the strong stock, we will short the weak stock. So our portfolio is usually a mixture of long and short, so that whatever the market happens, right, we will be able to profit from either side. Okay, so that is what we are doing. Currently, our portfolio is a little bit more neutral at the moment. Neutral in the sense that we have equal number of longs and equal number of shorts. But as market U-turn, right, we may add more short position. But let's say if market continue to rally, then we may add more long position. So we have a lot of optionality. Okay, we are able to choose individual stock. And one of the stock that we have is, I can give you a little bit of hint. It is related to gold. It is related to gold. The reason why we are picking up a gold counter is mainly because the remember the weakness in US dollar, and all the excuse me, and all the exogenous shock coming in to attack the US dollar, right? So we do want to capitalize on the weak US dollar, and if let's say US dollar were to continue to weaken, right, then gold definitely will have a good rally. If we look at gold prices, right, it kind of like bottom out here a bit. And then it did have a good rally in the past in last week. So we do hope that this one can sustain if let's say US dollar continue to weaken. Okay, so this is one of the long position that we have. You can go and find out what gold company, what gold mining company you want to long, but we are not going to reveal our our which company we chose. Okay, so it is mainly for our Patreon folks. Okay, guys. To summarize, I do not think this is the true bottom for S&P 500. Okay, I do not think this is the true bottom. This is a bear market rally, and I would think that at 3008 or maybe 3009, somewhere in between, it will U-turn again. So most likely we're gonna like go sideways or even rally into CPI. When the CPI come out, we may see another this kind of session depending on what the CPI reading is. Okay, guys. So do remember, you don't have to be binary. Binary as in you don't have to be 100% bull, 100% bear like that. You can always go with a mixture. You can be a little bit bull, you can be a little bit bear, and then based on what you see, you adjust. Okay, so if you want to know how to do all that, do come and join our Patreon or even our course. Actually, our 3-month course is gonna open next week, and I still have about 5 slots. So if you are interested, you can come and you can register for it. Yes, it is 3 months, because truth to be told, nobody is gonna learn trading on one weekend. In fact, 3 months is not enough time. If I were to give a proper trading course, it will be a 1-year course. But if I give a 1-year course, nobody is gonna come for the course. Okay. Okay, guys. So have a great day, and we shall see you again.